Well, thank you and good afternoon and welcome to the DoubleLine webcast titled Survivor with Jeffrey Gundlach and Andrew Sue. Please mark your calendars for two upcoming webcasts. On April 11th, we have our Smart Beta webcast with various portfolio managers. And then back up on April 25th, we have the International Fixed Income webcast with various portfolio managers. So with that, I'm going to turn the webcast over to Mr. Jeffrey Gundlach.
Thank you, Ron, and thanks everybody for joining us today. It's the first total return webcast of 2023. Of course, we did the Just Markets webcast a couple of months ago, and that's up at doubleline.com. It seems that I've been at this business for 40 years plus a little bit, and it seems like I'm losing company in terms of the old school bond investors that, you went through the 80s and the 90s and the 00s, the 10s and now the 20s. And it seems like everybody that was in the business with me in the glory days of fixed income back when yields were really high versus the inflation rate in the 80s, seems like they're all disappearing. I remember Bill Gross and El Arian and Dan Fuss, some others have all either passed away, went on to retirement, but I'm still here surviving. And I plan on surviving for quite a while longer. I don't know. I think I've managed to outwit and outplay most of these peers of mine, but at this point, at least I can say I've outlasted for sure. Also, these titles always have layers of meaning. We survived. I want to congratulate everybody for surviving the 7 years in the fixed income dungeon when we had yields of 0 or 1%, and 3 was almost impossible to get. Even 18 months ago, 5% was truly impossible. The only way to get 5% 18 months ago was to leverage junk bonds 50% and hope you get 0 defaults. That was the only way for a moment that you were able to get 5%. But now you can get 5.2 on the 1-year T-bill, and the 6-month T-bill is about that same number as well. We're talking about all of these things. So let's get started. I haven't used this slide in a long time, but it seems like it's getting more important. I feel like we're getting to a moment of awareness on the deficit situation. I think it was prompted by the Social Security trustees themselves admitting that under the current condition, they're going to run out of money in about 9 years. And of course, that prediction does not assume a recession, which is almost a metaphysical certitude sometime in the next 9 years. So they're probably going to run out of money for Social Security, not by the 2024 election, but I'm going to go out on a limb and say it has to be addressed by 2028. And we've been talking about this for a long time. We're going to deal with this, but we need to obviously start to get serious about our unfunded liabilities, which are 7 times our nominal GDP right now. So the red shaded bars, as always, are recessionary periods. And we can see that when we were worried about the budget deficit back in the late 80s and early 90s, when Ross Perot ran on the budget deficit as his major issue, we were running at about 4% of GDP in the aftermath of recessions. Now we're at 6% of GDP, and it looks like it's going higher. One of the big catalysts that's making the deficit go up is the Federal Reserve is now losing money thanks to their own interest rate increases. And so in past years, the Federal Reserve was subsidizing the deficit, sending money because they had a profit to the Treasury Department. Now the opposite is happening, and they're sending IOU that the Treasury Department has to give cash to the Federal Reserve System because to cover their losses. So this line has started to move up again. We obviously have the budget debt ceiling, the debt ceiling debate coming up later this year. As in the past, I expect that they're going to yell at each other and then find a way to paper it over. But I do think what's important is that Mike Pence went on a Sunday show 3 weeks ago, and he talked about we need to have a discussion about the deficit. And the context of his interview was clearly to prime his candidacy for the Republican nomination. So it's interesting that that's starting to come up. But obviously, this is really heading to be a big problem. And it's happening not in it's no longer your grandchildren's problem. It's our problem in real time in just a few years, and we will address it. One of the things that has been a catalyst making the deficit so bad as a percent of GDP is, of course, the ever-increasing fiscal responses to recessions. So in the 1990 recession, we didn't really have a lot of additional deficit. You notice there's a dark shaded part of the stacked bar that's called the cyclical effect. That's is intended to capture the increase in payments and decrease in tax receipts. So people go from tax givers to tax receivers when they get unemployed. So that's the dark shaded area. And then there's the lighter shaded area, which is just the ramp up of fiscal response, or a Keynesian type of response. And something really changed when the millennium changed over to the 2000s, because we suddenly see the fiscal response, the additional deficit, dwarfing the cyclical effect. So we've gone into this mode of ever larger doses of opioids, if you will, to combat these recessionary downturns. And it seems quite likely that this trend is going to continue. And it will be interesting to see how we deal with that while simultaneously having to reckon with this deficit problem and the unfunded liability problem that looms. I talked about the Federal Reserve losing money, and this isn't exactly the same thing, but it's a piece of it. We can see that government interest payments were below $1 trillion throughout history until right before the pandemic, and then it exploded in the response to the pandemic. And with rising interest rates, and the Fed very likely to raise interest rates by, I would say, 50 basis points after Powell's testimony today, the chances of a 50 basis point increase have gone up a lot in the betting markets and in the yield curve shape. So this is going straight vertical, and the Treasury Department needs to borrow a lot of money, but also has a lot of bonds rolling off in the next 3 years. And a lot of those bonds probably were paying out interest rates of 0 to 3%, and they're going to be replaced with yields of who knows, but right now it'd be 4 or 5%. And obviously the burden of the debt and the funding of the interest payments are really on the march. So this is an interesting slide because the markets have really been on the move, and the Fed has not had an opportunity to adjust their dots from December. So the little diamonds in the dotted line area, the dotted yellow line, that's the Fed's prediction last December of where the Fed funds rate was going to be at the end of 2023 and the end of 2024. And it was quite a bit higher than the bond market was pricing. But the 2-year Treasury yield, as we'll see in a moment, has risen by 90 basis points, actually 91 basis points now, in just the past 21 trading days. They hit their low the day after the Fed's last meeting. And the inflation data and the unemployment and employment data have been quite strong and revised stronger for December and January in the most recent reports. And so we've had a very large increase in short-term interest rates and a further inversion of the yield curve. And we'll get to that in just a moment. Now, I say, and I've said this forever, and I'll never stop saying it until it changes, we don't need the Fed. All we need is the 2-year Treasury. And someone on a financial program this morning pushed back against my saying that repeatedly, saying that the Fed does not follow the 2-year Treasury. Really? I mean, how can you look at this chart and say the Fed does not follow the 2-year Treasury? The red line is the Fed funds rate, and the blue line is the 2-year Treasury. And it sure as all heck looks like the 2-year Treasury leads the Fed funds rate, and they always end up in the same place. So as of today, this chart is dated very recently, but the 2-year Treasury today is at 5.01%. So it's gone up another 25 basis points in just the last couple of days. And it's now corroborating the idea that the Fed will probably take the Fed funds rate up to 5% at the upcoming meeting. The only way that won't happen is if the employment data and the unemployment rate that's reported this Friday surprises to the downside. That has not been the pattern recently. If it comes in at or above expectations, I think it's a lock that the Fed's going to go 50 basis points at a minimum. It really would depend how much the 2-year Treasury rises from here. But they're pretty much in sync now with the dot plots. The Fed said they were going to 5, 5.25, and the 2-year Treasury is right in that range now. This has been a monumental move, obviously, in interest rates. This starts the line at the bottom, the pumpkin-colored line. That's where we were at the end of 2021, and the blue line is as of a few days ago. So we see the 2-year on this exhibit was at 486, so it's gone up another 15 basis points since then. And the inversion of the yield curve has gotten much more severe in recent days. We now have the spread from the 2-year Treasury to the 10-year Treasury is 105 basis points, which is the biggest number going back for decades. And it continues to invert on an ongoing basis with some fits and starts, but the trend has clearly been heavily in place for the past 15 months or so. Here are various spots on the yield curve. We can see that 2-year Treasury now up at 501. This exhibit, again, is yesterday, so you have update it by a day, and it's already significantly different. We got the 5-year Treasury rate, which is now at 431. Today, long rates did not go up. The 10-year Treasury was barely changed in price. It was down 1 tick, and the 30-year Treasury actually rallied 11, 12 ticks or so. So we actually have long rates falling in response to the Fed getting more hawkish, which means we're getting further along in the cycle. But you really don't have recessions show up until the curve goes from a heavily inverted position and starts to de-invert. And we'll see that in the following slide. But first, let's check in with our old friend, the copper gold ratio. The red line is the 10-year U.S. Treasury yield, and the blue line is the price of copper in the commodity futures market divided by the price of gold. And they tend to track each other. This is using about a 6-year time window, and it suggests, the blue line suggests that the 10-year Treasury is about 100 basis points too high in yield. I didn't include the slide, but if we use a longer time window, about 10 years, the ratio actually implies that the 10-year should be at 250 based upon the ratio of the price of copper to the price of gold. So rates are off their highs. We had the 10-year Treasury at 4.25 a few months back, and now it's at 396. So we're 30 basis points off the highs. And I've been making the statement, and it looks like the market is cooperating, that it looks like 4.25 might be the high rate on the 10-year. And I think the long bond got to about 440, and it's at 387 now. So it's 50 basis points plus a little off of its highs of 2022. Some interesting slides I've never used before because they didn't tell much of a story because rates were stable for so long. But the Fed funds rate is now higher than the core PCE, not by much, but if the Fed raises rates up 50 basis points, it'll be significantly higher than the core PCE, which is running at about 4.7%, and the Fed funds rate looks like it's headed to 5 or higher. So it's interesting that we now actually have a Fed funds rate that has been matched by the PCE. For most of since 2010 or so, since the end of the global financial crisis, the Fed funds rate lived for a while below personal consumption expenditures, but now it's gone up to meet it for the first time since, well, about 5 years ago. Also, the 60-40 portfolio of stocks, bonds, 60% S&P 500, 40% bonds, has an earnings yield that's lower than the 1-year Treasury rate. And this chart's a little stale, so it's more negative now. So no wonder people aren't piling into 60-40 portfolios when you can get a higher earning power off of a 6-month bill or a 1-year T-bill, both of which are now above 5%. Also, the cash yield, which is basically sort of a little bit above the Fed funds rate, so commercial paper or something like this, is now higher than the S&P earnings yield. So not only is the 60-40 portfolio not better than the year bill, but even the S&P earnings yield is less than the cash yield. Okay, let's go to some recession indicators. We'll go fairly quickly through these. They haven't changed a lot in the last 3 months since we went through them most recently. The leading economic indicators are now very recessionary, clearly consistent with the last 3 red shaded vertical areas of recessions. And the 6-month one annualized is even more negative than the 1 year, year over year. So that means that the momentum continues to be gathering on the downside. So the leading indicators say recession. One of the exercises we like to do is to take the middle quartiles of the last of recessions going back in time and looking how indicators like this acted going into the recession. The black vertical line is at 0 on the x-axis. Is the official start to recessions, and we've averaged them out and have a median on here, and we kind of arbitrarily place these indicators for this cycle because we don't know when the recession is going to start. but we try to put it in a spot where it has the same shape as these medians and means from past recessions. And I would say definitively that this looks recessionary. In fact, I might even line this up to the right of the black line. The placement of the black line to the left of the vertical is somewhat arbitrary. It looks to me like maybe we're 2 months into a recession. Maybe we are, and we just don't know it, or maybe this one indicator needs more corroboration. Let's do the same thing for some other indicators. Here's the ISM manufacturing prices, and we've lined this up with the CPI. I think this chart's a little bit out of order, but I'll speak to it. Basically, we've got the blue line is the prices paid from the ISM, and the red line is the headline CPI, and we've got the blue line moved forward with a 4-month lead. And what this suggests is that inflation is going to come down. At least the manufacturing prices paid are suggestive that the CPI is going to drop down maybe to a three handle by the middle of this year, but then we have problems with base effects that might go back up again. But here's the PMI leading up to recession. So we're doing the same thought experiment here as we did with the leading indicators, and we get exactly the same result as the leading indicators. ISM manufacturing PMI suggests that a recession is going to start like today. So that's a sign that the lags of monetary policy may start to kick in, since the Fed really started raising rates in earnest last May. Let's do the same exercise for new orders. ISM new orders leading up to recession. We get the same look. It looks like we're very close to a recession. Let's look at the yield curve. And we're using here 2s, 10s leading up to recession. And what we see is we're definitely in the territory that would make us on recession watch. We're certainly sufficiently negative, more negative now than we were in either of the past 4 recessions, pre-recession periods. But one thing that we've drawn these red arrows on here for is the yield curve starts steepening or de-inverting before the recession actually hits for really all of the recessions that are on this exhibit. That has not happened yet. So that's one indicator that suggests that recession probably isn't upon us now, but is likely to be upon us sometime in the months ahead. Here's 2s, 10s leading up to recession. Same thought experiment as those others. I think this red line should be placed further to the right, but not all the way to the black vertical line. So we're getting close on a lot of these indicators. One that also does not suggest recession is imminent is the consumer expectations survey less the current situation. So what ends up happening is consumers, when they're surveyed, almost always have a cautious view of 1 year forward, even when they have a positive view of the present. And so when when that happens, that they have a reasonably positive view of the present, but a deteriorating view of the future, the line goes below 0 and you go into the red shaded areas. And we've gotten far enough into that condition that it looks like it's a harbinger of recession. But once again, you really need this to start to move up. And the way that would move up, the red shaded area shrinking, in other words, tends to be that consumers' view of the present starts to deteriorate. And the view of the future is still bad, but the present starts to meet it a little bit so that the shaded area heads towards 0. That hasn't happened yet. In fact, the most recent reading is the lowest for this cycle. So recession coming, but this doesn't suggest it's here yet. Another suggestion that recession's coming is consumer revolving credit having gone sharply negative with consumers flush with government handout money. Now they're using their credit cards a lot. In fact, significantly higher for quite a while now than during the entire 10-year period or 8-year period pre-pandemic. They're not doing this because they want to. One of the ridiculous things that you hear in financial media, equally as ridiculous as the Fed doesn't follow the 2-year, is that this going up is bullish for the economy. No, it isn't. People do not wake up and say, I want to run up my credit card today. They're running it up because of inflation, food prices, energy prices, higher rents, and higher used car prices until recently, et cetera. So they're getting to be in a more difficult financial situation. They're buying certain necessities on borrowed money. Next month, they're going to have to do it again, but pay the interest. And so that's kind of crushing. And as the Fed raises interest rates, the interest payments will go higher on revolving credit. Now, with what's much is made of the unemployment rate, and this is clearly very important to Jay Powell and the Federal Reserve. The unemployment rate is at a very low level of 3.4%. The 12-month moving average is at 3.76%. We're not really that close to the 12-month moving average, thanks to the downticks in the unemployment rate in the last few months. But we notice that when the black line crosses the red dotted line, so that's the unemployment rate crossing its own 12-month moving average, the last 3 recessions, that was really at the doorstep. When that crossover happens, is really right there at the leading edge of the coming recession. We're not there yet. However, this is the forecast of the unemployment rate by the Bloomberg Economic Consensus. And I would add to that the Fed themselves in their December dot plot suggested the unemployment rate was going to rise by 120 basis points from where it is today. That would clearly put it above its 12-month moving average. Let's go back and look. See, the distance of that yellow line is clearly enough to do it. And there's a fact that historically, the unemployment rate rising by any amount greater than 0.5% has always led to a recession. So the Fed, in predicting a 1.2% increase in their dot plot of unemployment rate, is implicitly forecasting a recession. And not a real mild one. With the unemployment rate going up by 1.2%, you're talking about something in the vicinity of 1.75 million jobs lost. Danielle DiMartino Booth, who was on our Roundtable Prime that's up on DoubleLine.com replay, she had a statistic in a webcast she did recently that if you take the states that are having job losses right now, it's more than half the states are having job losses. So the aggregate data looks pretty strong, obviously, but there's definitely dispersion among the states. And her fact was, and I found this very interesting, that 74% of the United States population lives in states that are having job losses. 74% of the population. So the conditions underneath the surface are nowhere near as strong as this very low unemployment rate seems to suggest. Here's a fun fact to know and tell. This is the FANGs, the FANG Plus Index with about 10 stocks in it. And that's the blue line with the shaded area. And then that red line is the FANG Index. The FANG Index is the red line, sorry. And the blue line is the size of the Fed's balance sheet. So the shaded area is the size of the Fed's balance sheet. And if you want to know when to buy and when to not own the FANGs, just follow the Fed's balance sheet. It's an incredible correlation that when the Fed's balance sheet is going up, the red line goes up, then the Fed paused and the red line went sideways. Then the Fed gunned it in the pandemic and the FANGs went wild. And then right there at the peak of the Fed's balance sheet is the peak of the FANGs. And the Fed is committed to quantitative tightening. One should not own the FANGs based upon this very powerful correlation. So 12-month recession probability versus the VIX, this is a very odd thing. Typically, the VIX, which is the red line, moves kind of in sync with the recession probability, but not this time. So the VIX looks like it's really depressed versus this recession probability. So I think we should be bracing for a survivor market when it comes to risk assets, because it seems quite likely that the VIX is going to go up. And we know from history that the VIX goes up typically when the market is losing value. So real rates are really important for risk assets. You'll notice that once the real rates started to go up in earnest a little over a year ago, we know that that was the peak in the stock market, or shortly before that happened was the peak in the stock market, depending on what index you look at. So we had that horrific sell-off that you had to survive back there in 2022, and then it stopped late in the year, around October, early November. Well, that's because real rates stopped rising. Real rates started to go down, and then we had a further sell-off when real rates rose. So right now, real rates have been going up a little bit, and we're starting to see, obviously, the month of February was a complete reversal of the month of January. It's weird how January was one of the best months ever for stocks and for long bonds, and February gave up all the gains in the Dow Jones Industrials, and yields did a full round trip. And that was fueled by and represented by changing real interest rates. So just as a proof statement that you should watch out for risk assets when real rates are rising, we've got the S&P 500 is the blue line, And then the red and the green shaded areas, that's the inverted 10-year real rate, so that we're going in the same direction. So real rates going up is the green shaded area getting bigger. And so what we see is the movement of the stock market since, I don't know, certainly I would say this whole time period really has been highly correlated to the direction of real interest rates, and they have started to go up again. And so we can see since September, these lines are almost indiscernible. The real interest rates are driving the picture. Also, one thing that seems to be driving the picture is the MOVE index, which is the volatility of bonds. And we can see that there's a very heavy correlation here with the S&P tracking the MOVE index. So about 3 years ago, 2.5 years ago, we started to recommend European stocks, really 18 months ago and 2 years ago. And we thought that the U.S. was going to start underperforming the rest of the world, and that has now happened. Going back about 6 years, we saw a relentless trend of U.S. equities outperforming the rest of the world, and that stopped about 18 months ago. And now we've broken that trend line. And if the dollar resumes its downtrend, which was pretty significant part of last year, we saw a decline in the dollar, and then we saw a rally off of the lows last year. The dollar, I think, is going to go down with this deficit problem almost assuredly, and that's going to lead to outperformance of the rest of the world. Europe has already started to work. That really peaked out back in 2020 in terms of the S&P outperforming. It had one Indian summer early in 2022, but now is definitively below that huge congestion layer. So Europe has been outperforming, and that's been the case year to date as well. Emerging markets, not so much. Emerging markets were tremendous performers versus the S&P from about 2002 into the global financial crisis. But ever since then, the S&P's been outperforming by a lot. It got all the way back to the same valuations as the late 90s and aftermath of the dot-com bust, but in the same vicinity. And now it's rejecting this overvaluation level by going below that horizontal line that goes back to the peaks 25 years ago. I do think emerging markets are going to outperform. We do need the currency, though, to start, emerging market currencies to start appreciating. That really hasn't happened yet. We'll see that in a moment. This is the S&P 500 versus emerging markets, and the dollar is pretty clear that the dollar is highly correlated to the S&P either outperforming or underperforming. So here is the JP Morgan Emerging Market Currency Index. It's been in a long downturn. There hasn't been much of a rally now for quite a few years. The rallies have been kind of sideways affairs and then leading to another leg down. But it has crossed above its 200-day moving average, not terribly definitively, but we're going to be watching this to see if we can go above. If you see the low back there in 2020, which contained the decline for about a year, but now if we can get back above that low of 2020, I think we're going to be in a dollar bear market, even versus emerging market currencies, but it's too early to declare that yet. Here's the Dixie Index. This is very heavy euro oriented, and we see that the dollar had that big run from 2021 into later 2022, and then gave half of it back, and now is consolidating. Today was a big update because the view of the Fed changed pretty radically today from almost no chance of more than 25 basis points to now 50 basis points being the odds-on betting. So let's take a look at inflation. Here's the CPI, and we see that it's at 6.4, and we see that the ex-food and energy is at 5.6. That next data point here is going to be important. We're still very elevated, of course, and the Fed wants these lines to go down. Here's the PCE, which is a little bit less volatile. And the Fed likes the PCE. They like the core PCE. That's running at 4.7. So between CPI and these two PCEs, I guess we can say inflation's running at about 5% or so based upon the official releases. Here's core PCE, core services X housing. Why does this indicator exist? Well, it's because Jay Powell started to talk about it in his last press conference. So we went from headline CPI Then we talked about headline PCE. Then we went to core PCE, which excludes food and energy. And now we're talking about excluding housing as well, which to me is not much of an inflation indicator. If you're taking out food, energy, and shelter, you're taking out the vast majority of people's lives. In fact, even by this index construct, core PCE services ex housing is only 28% of the PCE. So it's not capturing very much, but we have to watch it because this, Jay Powell said repeatedly in his presser of February 1st, that this was something that they are now considering as a guidepost in terms of inflation, and this is at 4.7. Clearly, he wants to get this down somewhere in the vicinity of where it was in that sideways movement from about 2016 to 2018 or so. Here's my favorite. So that's Jay Powell's new fangled inflation index. Here's my favorite inflation indices because there's no seasonal adjustments, there's no hedonics, there's no replacement. These are just export and import prices. And they got really high, up to on the export prices, up to about 18%, import prices at about 13%, and they've come crashing down. They're now running at very low numbers. In fact, the import price index year over year is below 1%, and the export prices are below 2.5%. So this suggests that inflation is going to continue to come down. Will it be fast enough for the Fed? At the present moment, the jury's out, and the Fed is not waiting to see what the data is. They're intending on raising interest rates again, and maybe by a larger amount than the last two meetings. This is the U.S. CPI and ISM manufacturing prices paid, that 4-month lead. We actually showed this earlier, so this is a duplicate. So it also suggests lower inflation. Here's M2 that nobody talks about anymore, except Dave Rosenberg, who's an expert on this monetary matters. And we see that M2 is now negative year over year. It came crashing down, and here we have CPI. That we're not putting a lead time on this, but M2 growth does appear to lead the CPI, and also suggests that inflation might be coming down. So we're getting into a moment where we're raising interest rates yet again, it looks like, maybe even a little bit faster, and inflation has been a little bit more stubborn than the Fed wanted, but it does look like it's coming down. What has been remarkable is the old St. Louis Fed's 5-year inflation rate 5 years forward, which is kind of a wonky thing, but it never got unmoored. It's basically, this is the 5-year never suggested that inflation was going to really erupt to the upside, at least on a sustained basis, and it's actually calmed down a little bit over the past year. So no inflation scare there. And here's the Bloomberg Commodity Index. We've been kind of neutral on this ever since the middle of 2022, when it kind of petered out on the upside. And I'm not interested in commodities with the Fed raising interest rates this much. And with all these recession indicators looking like we're at the doorstep, I think commodity prices need to get above their 200-day moving average. And that's a distance now. That's about 10 percentage points away. So I've been somewhat favorable on gold. Once it got to 1,800, it went quite a bit higher than that, but it's now come back down to almost 1,800. And I think gold probably deserves a role in portfolios at an 1,800 type of dollar price, even though the Fed is raising interest rates. Here's gold long term. Not much going on here. The thing's been dead sideways now for 2.5 years. So some volatility, but we're right in the middle of the range at that 1,800. Eurozone inflation. This is something a lot of people aren't aware of. People thought the Eurozone would never get inflation, but never's a long time. And we can see that the Eurozone was a little bit behind the United States, but that inflation rate really exploded higher and is still at 8.5% on the flash estimate of the Eurozone. And then excluding, they do food, alcohol, and tobacco, it's 6.3%. So pretty much higher than the CPI in the United States on the reported numbers. This is why I think one of the reasons the dollar is going to fall is the Eurozone is going to have to get more aggressive as the Fed is later in the hiking cycle. And so the relativism of the Fed versus the Eurozone will probably lead to a weaker dollar because incrementally, the Eurozone will have to be raising interest rates a little bit more, I think. Also, Japan, which people stopped even looking at inflation data in Japan because it was never going anywhere. But even Japanese inflation, there's the one on the left, it's running at 3%, which is considered, well, it's totally out of the recent context when it was always at 0. And then Tokyo, which obviously is a large city, its inflation rate is up at around 8% or so, going straight vertical. So Japan's in a real conundrum because they got so much debt and it's pretty much all being controlled by the government, and yet they have this inflation problem. German 2-year bond yield, not surprisingly, has gone up with their inflation rate. It was down at negative 1% at the low, and it lived down at negative 75 basis points or so for years. So this is what I'm talking about, surviving the fixed income dungeon. Think of the poor financial institutions in Germany, where they have to, if they're investing in German 2-year bunds, they got years and years of negative results. But now they're going straight higher. So this is happening in Europe, it's happening in Japan, and we've already seen a big inflation spike. It peaked out several months ago at 9.1 on the US CPI. So here's yield to worst, which assumes no default across fixed income sectors. So as I said correctly, 18 months ago, you had to leverage junk bonds to get 5. Junk bonds unleveraged are 8.6 on index level. And if you buy single Bs, you get 8.6. Triple Cs are expecting defaults, obviously, up at 13.2 yields. And the highest yield out there is leveraged loan triple Cs at 19.7%. I would strongly advise avoiding triple B bank loans because the covenants are virtually non-existent. We're later in the economic cycle, and these are floating rate loans. So when somebody is borrowing and Fed raises interest rates 500 basis points, their borrowing costs skyrocket. So this is really dangerous. I think that we will start to see significant defaults in triple C loans by the time this year is over. Here's emerging markets, what's gone on there just on a yield to worst basis. They got up to double-digit yields last summer, and then there was a plunge in yields of 200 basis points as people were reassessing risk, and now the yields have started to move up again and are now sort of at the high of the year at 8.6 to no defaults. Here's the spread on emerging market debt on an index basis relative to the US dollar, and of course the US dollar clearly is a driver of spread movement. So we see the dollar is the blue line, that's the Dixie, and the emerging market index, clearly the spreads widen when the dollar goes up and shrink when the dollar is going down. But we've seen emerging market spreads go from about 600 basis points of excess yield versus the treasuries to 450 if there's no default. So they still have tightened in by 150, but they're not close to retracing all the way back down to 2021 levels where the spread got down to a puny 325 or so. Here's spreads on investment grade in the US and high yield in the US to no defaults. And here we see a widening as well last year, and we've reversed about half of it in both investment grade on the left panel and on high yield on the right panel. High yield spreads seem tight at the present moment. They're about 387 over. That seems like a pretty low spread in the context of an inverted yield curve and the lateness of the financial cycle. Here's why you might want to be on the lookout for defaults. We have a survey of lending standards at major banks, and we see the blue line is the defaults on high yield, and the yellow line is the lending standards. And the yellow line going up means that the survey is reporting tightening of lending standards. And clearly the yellow line leads the blue line, and we've got this on a several month lead, and it looks like the blue line is going to be going up in conjunction with those tighter lending standards. So upgrading portfolios is a theme. This is strange. With the sell-off in risk assets in February, weirdly, the excess yield you get from the junkiest high yield bonds versus the highest rated junk bonds at double B, weirdly, that yield did not expand. It seems strange to me. I think that it should have gone up with the drop in the stock market. So I think that high yield portfolios, there's a fantastic opportunity here if you own the lower reaches of high yield, now would be an excellent time to consider getting out of that, because I think you've been lucky to have been a survivor this long. Mortgage rates, of course, are climbing. We see that mortgage rates were living forever at about 3% on the Fannie Mae or the Freddie Mac 30-year rate, and now it's back above 7 on that orange line. So very big increase in mortgage rates. Obviously, that is not helpful to housing activity. We see that still, though, the 2-year change of the national average Case-Shiller index is still very high. It's up 25% cumulatively over 2 years, although it is falling over the last 6 months. So there's still a lot of pent-up home price appreciation. It's probably this line's almost assuredly headed lower, but it's not exactly like we have an imminent default problem, anything close to it, because if your home price is up 25%, you clearly have the option of selling and booking a profit. But look at monthly mortgage payments for first-time buyers. They were back, let's just use, 2015, they were down at about $800, and they basically got more than doubled. So no wonder housing is in trouble with these payments going up so much. And obviously, a lot of this has just been in the past year and a half. So housing, this is a Goldman Sachs exhibit, housing, the most unaffordable going back 25 years using the Goldman data, and even significantly less affordable than 06, which was the prior least affordable market. So thankfully, we don't have the garbage financing that drove this blue line down from 03 to 06. So that's something that's good that we don't have to worry about. Also, we've got all this home price appreciation, but there's very little affordability. So not surprisingly, the MBA mortgage purchase index has taken out all readings, a new low, and had a really low reading in the most recent month. So not any economic strength here. And then we see the 30-year mortgage spot rate, and then the effective rate on mortgage debt outstanding. So interest rates fell. This goes back to 1998. They fell and fell and fell, and the stock outstanding, the 30 rate effective rate on mortgage debt outstanding, was always in the context of the blue line, the effective rate outstanding. But that's completely changed because we've had this spike in interest rates. So now there's a strange situation that new mortgages are being written at around 7%, but the effective mortgage rate that's out there is only 3.5%. What does that mean? Well, it means the prices of mortgage-backed securities have dropped a lot. And in fact, some of them are below 90. And so because of that, the risk of mortgage-backed securities has really been reduced very, very dramatically. The problem with mortgages and all callable debt is if you buy them at a price of 104, there's no good case. Your good case is just total stability that you earn your coupon. Because if rates fall, you're going to have a 4-point loss on the refinance. And if rates rise, of course, you're going to go down on rising interest rates, mathematical effects. But the debt that was outstanding, that was written a few years ago, still dominates the mortgage market. And so you don't have this no upside situation. If you buy mortgage-backed securities at 85, there's no problem with them going up 15 points, which is nearly 20%. So we have a fantastic risk rule. This chart, in essence, could be kind of nuanced, but it could be titled, mortgage-backed securities have very little risk in the existing mortgage-backed securities market because it's comprised of coupons on that blue line, which puts you at a significant discounted price because new mortgage interest rates are at 7%. So this is another way of getting to that graphic. This is the percentage. We've got various slices of coupon, the borrower note rate. And you'll notice that the borrower note rates are very heavily clustered around 3% or even in the high 2s. And there's really nothing outstanding of significance that's higher than a 5% rate. So everybody is out of the money. And 99% of outstanding mortgages have interest rates below this survey rate. So there's very little risk. If refinancing is actually your friend now, if it would start happening, it would be good. It's not very likely, though, with these rates so low and these mortgages locked in at rates that are so far below the market. This actually hasn't happened in the history of the mortgage-backed securities market. And I can show that using the measure called convexity. Mortgages have negative convexity. That's the degree of negative convexity is represented by the shaded red area. And so since interest rates just fell and fell, you had constant exposure to refinancing. So your upside was limited. Mortgage market was at a par or at a premium. So your upside was limited and you had lots of downside. Not anymore. In fact, the convexity of the mortgage market has been residing at effectively zero. It even went positive late last summer. So mortgages have really no risk. They're government guaranteed and they don't have this negative convexity problem. So they should have a really tight spread, right? Because the yield is way lower. But that's not the case. The 30-year par Fannie Mae spread versus 5 and 10-year Treasuries blended is actually quite high. Now, it's true that that 30-year par coupon has limited upside, but this filters across the valuation spectrum. They aren't as cheap as you get to lower and lower dollar prices, but on a basic historical valuation basis, there's absolutely the case that mortgages offer some of the best risk-adjusted yields in memory. So let's look at valuation of various securitized credit and compare it to the corporate credit market. CMBS is very cheap, and it's cheap because people are worried about it. So you have to have very strong credit underwriting and very discerning security selection, but CMBS is clearly cheap versus even lower rated index of corporates. Looking in the upper right, CLO AAAs have risen. So let's look at comparisons to high yield. The lowest rating of investment grade CMBS, which probably should be considered sort of a higher tier rating junk bond, but we're using triple B minus here, very, very cheap to high yield. High yield is really expensive versus triple B minus CMBS, and also CLO triple Bs are quite cheap. There's questions about the Fed selling MBS and won't that hurt prices of MBS? I would say they're not really selling. They are letting them mature and not rebuying them. And their buying had put prices up. I think when they announced that they were going to let them roll off, we saw spreads widen a lot. There was quite a big underperformance of agency MBS at moments last year. And now there's so little supply because the purchase index, as we show, is so low and there's nobody refinancing. So we actually have very low mortgage supply. I would sort of argue that the impact of the Fed's quantitative tightening was really discounted, as is so often the case in the markets. There's a question I thought was interesting, acknowledging a correlation between the Fed's balance sheet size and the FANG index. The question is asked, is that relationship causal? I think yes, I think it is. I think when the Fed is expanding its balance sheet, it's green light for people to take risk. And they're flooding, they're adding liquidity to the system, and that follows through into momentum. And FANG stocks are momentum stocks. And so people want to get on the train that is moving fastest. And so they go into these high flyers, and they've gotten absolutely killed in those high flyers. And I think they're going to get killed again when the market starts to have to react to these Fed hikes. Here's an interesting statistic. Thank you for this. 52% of U.S. Treasuries, I knew it was a lot, but I didn't have the exact percentage point, reprice over the next 3 years. Is there a level in your view where the Fed has to stop raising interest rates due to fiscal dominance, et cetera? It's an interesting question. I think the Fed is in a hurry to raise interest rates because they know that there's all these treasuries coming due. And I think they want to get the interest rate hikes to not be in place, that they have to roll over all these treasuries at much, much higher yields, making the fiscal situation worse. So I think there is something to that. Will the low interest rate environment over the past 10 years delay or reduce the high yield default? Really good question. And I think it introduces an even more interesting broad point. Obviously, low interest rates with a lot of borrowing at those low interest rate levels will delay high yield defaults to a certain extent because they don't have to roll them over, at today's interest rates. So their payments aren't going up if they're fixed rate payments. That's not the case, of course, with bank debt. Bank loans float. So every 3 months, you get a new interest rate bill, and that's usually a couple of Fed meetings. So you've had interest rate bills go up by 1% a quarter. So 1%, 2%, 3%, 4%. I think the broader question is, how will the default cycles look in the context of higher interest rates when the whole high yield bond market has lived its entire life until about 18 months ago with a broadly declining interest rate structure? From the early 80s, when high yield was sort of first accepted, we had endless refinancing cycles. So how many high yield bonds over the past 30 years have really paid off? They probably either defaulted or refinanced. So what does it mean if interest rates are rising, and if we posit that they stay high long enough that a certain fraction of the high yield market has to actually mature and then float that debt at today's interest rate levels? I think that will accelerate the default cycle. What we think we know that's been informed by 40 years of sinking interest rates or stable interest rates, we probably have to double check and make sure it still makes sense in the context of a different type of paradigm of rising interest rates. So I think your question is partially right, that it will delay the cycle of high yield defaults a little bit. But I think after that delay is over, if the economy is still struggling with high interest rates and weak GDP, that we will have the highest default volume of all time. That's the conclusion I've come to thinking this problem through. So with that, we've gone an hour and 5 minutes. We'll wrap it up. And thank you for, this is our third year now of doing the webcasts with video. In the past, it was all audio. I think we're going to continue with the video going forward, even though we're going back to the office and all that stuff these days. So with that, thank you for your support of DoubleLine. Thank you for listening to the podcast today, the webcast today, and good luck with what I'm sure will be the year where it'll be not the easiest to survive yet again. Thank you very much, and goodbye for now.